Hello, welcome to the Australian's Money Puzzle podcast. I'm James Kirby, the wealth editor at the Australian. Welcome aboard, everybody. What I've been reading of late, I'm just starting to wonder, are we complete schmucks if we actually do some things in the property market that never pay back? I mean, if we build a garden and we keep this gorgeous tended garden, and we put the house up for sale, no one gives it any value. If it's not a heritage listed house and we lovingly restore the window frames and the chimney, are we actually complete fools because we don't get any reward for that materially in the market? It's ignored. And even on a big scale, when it really comes to investment, when you're really putting your money on the line and the nature of the property you buy. If you buy an apartment, for instance, there's some data now, local data, in some areas which shows that apartments, for instance, have barely kept up with inflation in whole tracts of the major cities. So you wonder, if you had the choice, would you ever buy an apartment? Again, it's the same theme. Are we silly sometimes in not being, I suppose, pragmatic enough in the property market? I've got the perfect person to talk to about this today. It's Stuart Wemyss of ProSolution. Hi, Stuart. How are you?
Great, James. Thanks for having me back.
I'm delighted to have you back. It was something I read by you that made me think not just about apartments, but that whole areas of property where maybe, your human instinct is to prettify something or improve something in some way or restore something. And you might say, let's start with apartments, because you say, okay, I can only afford an apartment, right? You say, X, I want to be an investor. I've never done it before. I can't afford a house. I can only afford an apartment. But maybe you can afford a house. You probably could. I mean, in fact, it's, an apartment in the city, a house in regional Australia probably costs the same. Yeah. So does it, I want to put a straight question to you. Does it, if you could avoid it, does it ever make sense to buy an apartment as an investment?
Look, I think the main attraction to houses are the land value.
Yes.
And the second attraction is control. You've got full control over that asset. Whereas if you buy an apartment that has a body corporate, the body corporate looks after the apartment building. You might want to make some improvements to that complex, but you might not be able to because people aren't willing to put the money in.
Right.
And so you lose a bit of control when being an apartment investor compared to a house. But the land value is the main concern here because, buildings can appreciate over time, and certainly the cost of building has risen substantially over the last couple of years.
Yes.
Of course, that's unusual. So buildings can appreciate, but it's really the land value that's appreciating. But
if I said to you, Stuart, you have a choice from now on. You need never buy an apartment again. If you can buy houses, just houses. Would you actually say no? There are times where apartments make sense.
I think it depends on the cycle. It depends on two things.
Okay.
Your budget and the cycle.
Okay.
So your budget, if your budget allows you to always buy a house, I would always buy a house.
Yeah, right.
As long as I'm not compromising on the location of that house, right?
Yeah.
So as long as it's going to be a great quality property in terms of locality and type and so forth, I'd always buy a house.
Yeah, yeah.
But of course, we all have limited borrowing capacities and limited capacities in terms of investment. So, of course, that's a silly thing to say. So then if I had a budget of, let's say, 800,000, because 800,000 won't be enough to buy a house in a major capital city, not a good one, not a really high quality one.
Yeah, prime property, okay.
Unless you're 20 or 30 Ks out from the CBD, or you need to go into a regional area.
Right.
So if we reframe the question, should I buy an apartment in the city in a great blue chip location, or should I buy a house either in the outer areas or in regional areas? The second consideration, so to answer that question, what I would consider is that where are those assets in the cycle? So as you alluded to in your opening, apartments in Melbourne, Sydney and Brisbane over the last, say, 10 years have underperformed significantly.
Just tell us a little bit more about that. You showed me some work where apartments hadn't even kept up with inflation in some districts.
In Melbourne, the median apartment price has appreciated by 2.6% over the last 13 years, and inflation was bang on 2.6%. So
that's hopeless, right?
That's terrible.
That's hopeless.
That's a
and your rent isn't gonna. Your rental yields are in absolute terms hopeless as well, really, because you're probably borrowing at more than your rental yield. So you're saying to me that apartments in Melbourne broadly have been a loss maker?
Absolutely. Yeah, but from a median
For a decade?
value for more than a decade. Yeah,
right.
correct.
Right. So
Which
is that
unusual.
it's unusual. Okay,
It's unusual.
So it's an aberration to some degree historically. It
Well,
shouldn't be that bad.
Between 1980 and 2010, that 30-year period, apartments in Melbourne appreciated by more than 9% per annum.
Okay.
In value. So
The 30 years before I started investing.
that's right.
Yeah.
So you might argue in 2010 apartments were overvalued in Melbourne, but equally you could argue today that they're either good value or potentially even undervalued.
Okay, right.
So if you had a time horizon of a very long time horizon, I would say more than 10 years, I'd buy an apartment because that mean reversion will kick in. We've seen
You're confident of the mean reversion.
It will.
You think everything reverses to the mean?
Well, because the underlying land value of these properties has definitely changed.
Okay.
It is definitely worth more than it was 13 years ago.
Yeah,
it's just prices don't yet reflect that.
Okay.
So, and we can see that. We've had clients sell whole blocks of apartments that get together with all the other owners, and they've doubled their money. Like in terms of if they sold the apartment as a single unit, they get $500,000.
Yeah.
And this client sold, he walked away with more than $1 million.
How often does that happen?
Well, it doesn't normally happen because normally it's not economical for a developer to go and buy 10 individual apartments. They normally have to overpay. But in this market, because apartments haven't moved in value very much, it's becoming more common, but it shouldn't work. Right, a developer shouldn't economically be able to go and buy a block of units and pay.
So that's telling you how reasonable they are, I suppose. And this is more likely to happen in smaller, older, middle ring apartments, I assume, where you've got 10, 15 in the block.
Oh, absolutely. And sometimes sometimes you can have like 4 on a parcel of land of 850 square meters. You know, if a developer built an apartment block on that parcel of land today, they'd be building 20 or more units. So they're very land value heavy assets.
Okay, it's interesting. I thought you were going to say, actually, the apartments have been a disappointment for a long time. Keep away from them.
Yes.
But that's not what you're saying, actually.
Well, it's about sort of being a bit counter-cyclical, I guess.
Sure.
And, should you buy a stock after it's risen 200%? Or
should you buy Nvidia today?
Yeah, exactly right.
Will it double again?
Yeah, that's right.
Yeah.
Now, it could. And the apartment market could persist in terms of its underperformance. But it's not going to persist forever because it doesn't make sense.
Yeah, right.
More people will start to be attracted to apartments. Both from an investor perspective because of rising rental incomes, and also, they just look better and better value compared to houses.
And Melbourne is the soft spot nationally for the apartment market?
Yeah, Melbourne's got the worst performing apartment market. In Sydney, apartments haven't done much for about 6 years, so only half the time in Melbourne.
Right.
And the last couple of years in Brisbane have been very strong, but the previous 10 to 12 years before that were also terrible as well.
Okay.
So
it's encouraging really for first-time investors because for most people, it is your first step.
Yeah. I think so. Now, it's the only question, to my mind, it's not a question of will that mean reversion kick in. It's when will the mean reversion kick in. So I don't know if that'll be in the next 5 years. It could, but I'm certainly going to be in the next 10. Okay. Which means that if you wanted to make some quick money in the property market, maybe don't go to the apartment, maybe go to the house.
And tell me, is there a type of apartment that you think is particularly, would be particularly lucrative as a style of apartment or the nature of the apartments out there?
Well, I think because of increased work from home, you would want a 2-bedroom over a 1-bedroom.
Okay.
A 1-bedroom doesn't really lend itself to people working from home. Yeah. A 2-bedroom plus study is kind of perfect. Yeah. Okay. From that perspective. Okay. Because the person can share that apartment with another renter, right? Or they could occupy both those rooms and have that space to work from home. So I certainly value 2 over 1 bedroom, and then you've just got to really look at the underlying land value. If you're buying into a block that was built pre-1960s, that doesn't have that many apartments on the block, it's in a great street in a great location, it's probably going to make a good investment. Okay. Okay. What about the other part of what I said there in my preamble about, are we wasting our time? It seems to me we are.
if you were utterly ruthless about and pragmatic about property, I don't know whether you would ever buy a pretty house, an older house, a house with any significance, a house where someone interesting lived in it before, a house with a garden. It seems to me in the cities, this stuff, these issues make for very little when it goes to auction. Am I being fatalistic? Am I being too hard?
No, I think it depends on the location.
Okay.
You know, and the architectural style in that location.
Right.
So, you know, there's pocket suburbs where, you know, Victorian properties are kind of what's desired in that location.
Okay.
And, you know, if you had a modern build dwelling in that location, it's probably just not going to work.
Okay.
So that is if you change the property so significantly that it stopped looking like a Victorian, I think you're probably doing yourself a disservice.
Okay, right.
But buying something that's because of its history or because of its particular architectural style, you're probably signing yourself up for more maintenance costs than you really need.
Yeah.
And that might appeal to some owner-occupiers, you know, when you go to sell it. But it's going to be a very narrow part of the market. And really what you want is wide appeal whilst trying to minimise your maintenance
that whole
costs.
thing about many years ago, I remember, and this is a long time ago, I was actually a property reporter once upon a time when I came to Australia first. And I was, there was a interesting, almost like a villa house, townhouse for sale on a street in the middle of Melbourne, Little Latrobe Street. It's still there. But in those days, there was very few people living in the city. It was most unusual. Yep. And it was a fashion designer, a well-known fashion designer, lived there at the time. And I went up to visit the house. It was for auction. And there was a very well-known real estate agent dealing with the house because it was a prestige property. It was going to be in the papers. It was a glamorous property. And I said, we looked at the house and I said, this is terrific. It's really fabulous. And someone lives here in the city. It's so unusual in a house in the middle of the CBD. And he said, this is going to be murder to sell. Nobody wants this. Nobody wants a house in the CBD. This is a complete outlier of a house. It's gorgeous, I know it, but it's going to be murder to sell. And I remember it really was a lesson.
Yes.
That distinction in and of itself is not actually a sales pitch or an allure for most buyers.
Yeah, you just want to have something that's in keeping with the area, but it doesn't need to be the best property in the area.
Yeah, right.
You know,
right.
It just needs to have the propensity to be the best property in the area in terms of its locality.
Okay.
But yeah, architectural style. Look, before you go and sell the property, you might want to make some improvements, like spend a bit of more money on the garden. And
but that's really just cosmetic for selling.
That's just cosmetic. Yeah, correct.
Yeah,
correct. But you don't want to buy an asset as an investment that requires that level of expenditure throughout the ownership period.
Okay. Now, entirely different subject. Still obviously within property, but very different. Everyone is telling me that the Victorian land taxes, the unexpected string of land taxes that kicked in roughly a year ago, which did come as a surprise, though they were coming for a long time, from the state government, the state Labour government, at the time, the last days of the Andrews regime, to be precise. That they are really making a difference here. That it partially explains why the city property is lower and weaker than the other areas, but there are particular areas that are really harder hit. This is more middle to upper properties on the peninsula, etc. Have you seen? Could you tell us basically what happened there and what you're seeing?
Well, because the Andrews government brought in the COVID levy, which was really not really what you would expect from a Labor government policy, because what it meant was that it raised a lot more land tax, but the burden was really spread across people that didn't have very substantial land holdings.
It brought it into the city, wasn't that it?
What they really did is reduce the land tax threshold to $25,000.
Right. Yes. Yeah.
And so if you more than 70% of investors only own one investment property based on ATO data. So most property investors are going to buy one property, but only a very small portion will go to the second. So really what you want to do as a state government, if you want to solve the rental crisis, is you want to attract more first-time property investors, because that's the largest cohort. Well, the problem is that if you go and buy a property, an apartment or a small house, let's say for $800,000, for example, if you did that in New South Wales and Queensland, you're not going to pay any land tax.
Oh, yes.
But in Victoria, you will.
Right.
And so if I'm a first-time investor and I didn't really care geographically where that investment was going to be, I'm probably not going to make that investment in Victoria based on land tax alone.
Okay.
Now, you can't make decisions just based on one particular tax.
Yeah.
There's a lot that goes into it, so we don't want to be too tax sensitive. But that's really the biggest challenge, I think, for the Victorian property market is because land tax kicks in at such a low value. More investors will pay for it, and more first-time investors will pay for land tax.
I wonder, is there any way of finding out if the first time... I know that the investor activity is lower in Victoria and has dropped clearly as a result of this land tax and these new land taxes. But is there a way of finding out whether first-home buyers, first-time investors, I presume they're not separately calculated?
No, I don't think they're separated anywhere, but I think we could assume that if investment overall is lower, that certainly first-time investors are lower. And look, people, people like the comfort of popularity. When a market is popular or a stock is popular or investment is popular, it gives them that sense of comfort.
That's right.
So conversely, to invest in Melbourne now when it's kind of lost its shine because of the debt situation, land tax situation. You need to be brave to invest in Melbourne. Now, I think investing against the trend, you know, it shows long term. If you invest in quality assets, you'll do very well.
Sure,
but that's not for first time investors. Mostly. That's
you're bringing your Warren Buffett. You're be fearful when everyone's greedy and greedy when others are fearful. It's exactly the Buffettology, isn't it? Really,
exactly right. And it makes sense. It stands to logic, right? You know, it's Melbourne is going to have a larger population than Sydney in the near term. You know, there's a lot of fundamentals there in terms of population growth and land supply and those sorts of things. So I think long term it'll make a great investment. I'm very optimistic, and I think it's possibly one of the most undervalued markets at the moment.
Right.
But do first-time investors have the chutzpah to make that decision? That's a big question.
Because as you say, when you're a first-time investor, what you want is comfort. You're not going to take a gamble with your life savings, basically, the first time. When you get more experience, you're more prepared to go against the grain, as you say. Okay, we'll take a short break. We'll be back in a moment. Hello, welcome back to the Money Puzzle. I'm James Kirby. I'm with Stuart Wemyss, who is a regular guest on the show, author, podcaster in his own right, and very popular guest always on all things property. Okay, first questions from Michael. These are really good questions this week, I have to say. I'd be really interested to see what you think.
Yeah.
So he says, we live in inner West Sydney. Our home is old. Nothing is built to code. Nothing is square. I know. We all know about that. We are in our, not our first house, our second house. We used to have a little game where you could put a tennis ball on the floor and just watch it go on this amazing roundabout. Because all the floors we could not level them. But he says, but we love our neighbourhood, and we've explored renovating, but 2 engineers are recommending a knockdown rebuild. The cost of renovation is too excessive. Okay, so he says, here's the rub. Our local council is reticent to allow a knockdown rebuild for heritage reasons, and builders and architects are pricing themselves out of the job. We found a builder who is willing to take on the role. It's a great question. Is a knockdown rebuild worth it in the long run? So you see the issue. I'm sure people have this issue all the time. They like the house. They bring people out. People say, listen, it's going to cost you so much. You'd be better off to knock it. And I'm sure it's often true. It's very hard to say that sometimes, stand in front of the house you love and say, yeah, let's knock it. You have to be terribly pragmatic to do that. Mm-hmm. Is 9 times out of 10, is the knockdown worth it over the painstaking renovation of something that's transformed and looks so different that you might as well have knocked it anyway?
The benefit of knocking down is that the cost to replace is a lot easier to ascertain or to be sure of.
Yeah, right. Okay.
The chance of cost overruns are greatly reduced than trying to renovate something that's pre-existing to try and convert it into something more modern or usable, I should say.
Yeah.
And the other thing is to think about is over-capitalizing. How much money am I going to spend, which I think Michael sort of kind of alluding to.
Yeah.
And the thing I would put to some people is overcapitalising a big deal? Like, which might sound like a strange thing for a financial advisor to say.
I don't think so, because I know what you're saying. Over the long term.
Well, if you're going to stay in that property for 10, 20 years.
That's right. Who cares if you spend 20% more than you wanted to 20 years ago?
You're probably
10 years ago.
Back. That's right.
Yeah, you get your money back.
And as long as the debt is, the debt isn't as a result of the overcapitalisation, as long as the debt's not crippling, that you don't need to sell the asset one day to repay the debt, or that the debt doesn't absorb all your surplus cash flow.
And of course, it's not tax deductible. This is a home.
Yeah, that's right. So as long as the debt's okay, then it can be a conscious decision where you can say, I love the place, I love the architectural style.
Yeah.
I know it's going to cost me more, but I can wear it. And I know that if I have to sell the property in the first 5 years, I'll probably lose money.
Yeah.
But if I'm going to keep it longer than that, chances are I'll at least get my money back.
Yeah.
And you've got to put a value, I think, on your standard of living. To live in an old house that doesn't really suit your needs isn't necessarily an enjoyable experience. Whereas you may as well spend the money now rather than in 5 or 10 years' time.
If you have it,
utility,
if you can get it.
If you can get it.
Yes, yeah, terrific answer. I really think that's very, very interesting, and it was a great question. It's funny it didn't come up before. That's from Michael in Inner West Sydney, facing a problem that so many people do face. Thank you for the question, Michael. I hope it was useful to you, listeners. I expect it was. I mean, in a way, obviously, every situation is different, but it's worth doing the numbers. And you do see people doing such extensive renovations, you wonder, oh, gee, they would have been better. I think, in my experience, where this goes wrong is where the person doesn't knock a building and they find that the original building was built so badly. He says there's no code. It was days before regulations. They were built so badly that you find the builder says, unless X and Y happens, you should be fine. And X and Y turns out to happen. Everything's there. It's damp. The walls are crumbling, whatever.
And the other thing, James, is how much are you overcapitalising by? We had some clients that I was dealing with last year, and they had to spend an inordinate amount of money on this property. Yeah. And we ended up deciding just to do a renovation, but pull the scope back a lot to limit the amount of kind of overcapitalisation. Because they
could see how it was running off the runway, was it?
Yeah, and because it's such an older style property, you had to spend a lot of money on the non-cosmetic things, that didn't really add a lot of value to
no one sees.
The property that no one sees. Exactly right. So it does depend on individual situation, individual properties. But as a general rule, I wouldn't be that worried about overcapitalising in some circumstances.
So that is the core message there, everybody. Don't worry too much about overcapitalising, assuming you're going to stay there. Because we have the long-term historical trends that the prices will improve over the period of time, and it's your home, of course. So you get the benefit of it straight away when you get into that newly built or newly renovated place. Nina, we landed back in Australia in 2020 with a sweet 150k boost from our folks in 2022. Then a curveball. I wouldn't call it a curveball. I would call it, a good fortune. $500,000 inheritance from my husband's mum. To save this amount would have taken us a lifetime. This is really interesting the way this question unveils itself. Sydney property dreams, think again. St. Ives, Inner West, North Shore, we scoured them all. A house felt like a mirage. All that cash, and we were still looking at units. Now, we've been living in units since we were 18, and we're now 32 and 36, and we said, no, not again. Neither of us have any more debt, except little HECs, and we have a pre-loan approval of up to, and she gives the numbers. Here's the kicker. Frustration led us to Newcastle. Now, here's the twist for your podcast musings on regional Australia. It's not just investors. Skilled workers like us are seeking space, and the cities are losing talents to the regions, and we're living proof. Well, thanks, Nina. Very interesting. Whether you forgot to, I'm not sure, but you didn't necessarily say it was a great success to move to the regions, or that I expect it has been, but that's not actually there in black and white. I did something recently for the Australian where the regions they're supposed to have cooled down after COVID, right? They're not. They're actually on a monthly basis. The prices of units and houses are actually rising faster than the metropolitan centres. So yeah, I think Nina and her cohort, it's a deep trend. region in Australia. And I think for years, people like you and me on shows like this would have been, it was very, very much a secondary market, wasn't it, outside the cities? Like Hobart was just a different story altogether than Sydney or Melbourne. And I think that really has changed.
Yeah, I mean, speaking to some buyers agents, they sort of made the comment that prices have probably come off about 15% from their highs during COVID. So sometimes that's lost in median data.
Yeah,
but that's like for like in terms of dwellings. So
I've been talking about, I suppose, a surprise upturn in recent months. Take that on board, everybody, that they did fall. Yeah.
And I think Newcastle and Geelong are the exceptions.
Oh, you think they're exceptions?
Because
they've got everything.
Because they're large enough that they do actually attract employment opportunities, that people can move to those larger cities.
But they are cities.
They are, And we've had clients own property in Newcastle for the last 20 years, and it's done, you can buy incredibly well in that location. Same with Geelong. So I think I would agree that the long-term prospects for those two locations are very positive.
Yeah.
Now, that's not to say that you can't go to other regional towns or cities that will also be attractive.
Yeah.
But they don't have the same supply and demand fundamentals that Newcastle and Geelong do.
So you see them as, because they're bigger, because they've got that bit of scale and scope and variety and diversification of property and de facto employment opportunities in the town as opposed to working from home.
And proximity to a major capital city.
And you can slip in on a train.
Yeah, exactly right.
To the metros. Yeah, very interesting. Hey, thank you for that, Nina. Thank you very much. Very interesting.
I might actually add, James, just to interject. Nina spoke about having a HECs debt, and also she highlighted that her borrowing capacity had come down over the last couple of years, which made sense because of interest rates rising. So just particularly for any first home buyers or investors out there, what I probably would have said to Nina is repay the HECs.
Yeah, right.
Because the HECs have a huge impact on your borrowing capacity.
On her borrowing capacity,
because you've got to repay, up to 10% a year off the balance, which is a large ongoing commitment.
Yeah.
Whereas if she just took a little bit of that, she's got a very large deposit now because of the inheritance. If she just took a little bit of that deposit, repaid her HECs, it actually increased her borrowing capacity.
When she goes into the bank.
Exactly right.
Because they're looking at the HECs.
Because they're looking at the HECs.
Yes, which is underrated, that, isn't it? People say, oh, HECs, put it on HECs, it's all so easy. I think people have slowly realised, due to inflation, that it goes up, right? The rate doesn't go up, but inflation goes up, and unfortunately that means that it goes up. I think that was a shock to many people. And maybe the second shock is that it's on the forms when you fill out for a bank loan.
Yes.
And it holds you back.
And a few years ago, they changed the repayments, like the amount that you had to repay. They really increased that. So, and then first-time property buyers tend to be quite sensitive on borrowing capacity. So even these small changes can have
make a big difference. Okay, terrific. All right, we'll take a break. Back with the last question from Bailey, who's getting married and has a variety of questions for us. Okay. Hello, welcome back to the Australians Money Puzzle podcast. I'm James Kirby, wealth editor at The Australian, and I'm talking to Stuart Wemyss of ProSolution. And we are talking all things property and information around property, never advice, but good information for you on matters to do with money and property and life itself. Okay, Bailey says, B-A-I-L-E-Y. I'm getting married later this year. I'm a relatively high income earner in the top tax bracket. My partner is working part-time while studying, so in a lower tax bracket. I have some property investment. What are some things to look at that may change when we get married, and or what can we do to maximize the benefits? Are there common pitfalls to avoid? Whoa, well, we could have a whole show on this. We could have a whole series on this. We won't do that. We will narrow it down to the specific financial situation here, where there's one person obviously is in the 47% tax band, and the other person might have might be extremely low tax band. If they get married, Billy and her partner, or in this situation in across Australia, if any couple in this situation were to get married, does it make any difference at all to benefits and pitfalls that they could avoid?
I was looking forward, James, to hearing you tell me how you can maximise the benefits of being married.
Well, you're the advisor. You can tell me the benefits. But there's no, because the law assumes de facto and everything. There's no particular problems or benefits. Or am I entirely off the mark there?
Well, it certainly has a big impact on your borrowing capacity, because now you've only got one household worth of expenses and you've got two incomes. And so the combined borrowing capacity of two people, two individuals, is more significant.
They don't tell us whether they're living together or not. Well, you're assuming they're going to.
Well, I'm assuming if they're getting married, they're probably going to live together at some
I presume
some
they
point.
will. If they get married, I presume they will. Okay, so there's in a situation, but that's not necessarily to do with marriage. That's got to do with the economics of living together in the one house. Is there, and the tax she seems to be familiar with, obviously, that where you can, the lower tax partner would be exposed to tax more often if it was a voluntary situation where you could choose. Any common pitfalls to avoid?
If you had an imbalance of taxable income, of course, you could take that into consideration when determining what your long-term plan looked like.
Yeah.
But I know that the partner is studying and in a lower tax bracket while studying, so that might not persist. Once they finish studying,
you'd assume so.
I'd assume their income's going to rise significantly, which might sort of close the gap between individuals' taxable incomes. From a financial planning perspective, when two people get married, and it might seem obvious, I think the first thing, the best bit of advice I would give is get on the same page. Get on the same page about how you want to deal with money and what your financial and lifestyle goals are. And I don't think it happens that often. Normally,
can I hit you with a question without notice? Do couples come in and you get this sense that they are completely different financially? That they are not in an obvious manner, like one person is really interested in money and careful and one isn't. I mean, but more complex than that. Like you might get someone who doesn't care much about money, but then is perfectly keen to speculate because they don't care about money. Do you get couples where they're just miles off and you're trying to trying to put them on the same road?
Yeah, and it's really difficult.
I bet it is.
Because they've got completely different risk profiles.
Risk
appetites. Interest and engagement is an issue as well.
Yeah,
one person couldn't care about investing for tomorrow. It's all about living for today.
Yep.
And the other partner's the reverse.
But there is an upside there, isn't there, with people who don't care so much about money, that they will take risks that the person who cares too much would never take.
Yeah, so that's sometimes a double-edged sword, though.
Yes.
Because they will take uneducated. It's good to say educated risk, but uneducated risk, I think, is not so great. So I think getting on the same page is going to set yourself up for not only financial success, but probably marital bliss as well.
So how would you do that? Would you say, would it literally come down to you saying, are we agreed that we're going to do A, B, and C?
I think I would encourage spouses to have a level of engagement. So it's very common where one spouse really drives the financial decision making, and the other spouse is not
power of veto.
Yeah, well, not totally disengaged, but they kind of just leave it. Well, that's your job. I'll let you run with that. But you've got to be careful, and you've got to be careful. It is your money. You should take an interest.
Yeah.
And if the relationship dissolves one day, you look back and go, well, I should have taken a greater interest. So you don't necessarily have 100% engagement in that whole process and input, but you've got to have some input. So what I would say is the two partners need to sit down and work out what are our priorities. How much do we want to allocate of our financial resources to enjoying our lifestyle and living for today, and how much are we going to contribute towards tomorrow? And what does tomorrow look like? Are we planning to work really for the rest of our lives because we love our jobs, or is it a case of, look, I would love to retire tomorrow if I could afford to, or is it somewhere in between those things? And normally those goals and that discussion then help inform them about what risks they need to take and that they're willing to take with respect to financial decision making.
Gee, interesting. Very interesting. So it's funny, isn't it? When you get down to brass tacks, personalities matter so much.
Yeah, and it's something,
and risk profile or even disposition. Yeah.
I think there's probably two things we don't really discuss well enough when we get married. It's parenting styles and financial investment. I think having those conversations up front and getting on the same page and understanding we're all different, of course, we're going to take different approaches.
Yeah.
But I think if you can get on the same page and have very aligned goals, financially speaking, just purely financially speaking, that's probably the best thing you can do to maximize the value of getting married.
Very good. Terrific. Oh, there you are, folks. So thank you very much for the question, Bailey. It triggered a very interesting tributary down which we went, and was very glad we did. Okay, thank you, everybody. I hope you enjoyed that. Let's have more questions, comments, and even observations like we had there today, which can actually lead to some really interesting discussions with guests. The email, themoneypuzzle@theaustralian.com.au. Thanks, Stuart.
Thanks, James.
Talk to you soon.